Hello, everyone. Welcome here to our Value Balancing Alliance webinar on establishing resilience indicators for transition finance. We're going to give it a minute or so while we are waiting for everyone to join in, and then we kickstart swiftly with our overview on today's agenda and the welcome remarks. Great. I see people joining us on the dot. So I kickstart the official part now of the webinar. Nice to meet you all. My name is Martina McPherson and I lead the financial markets work at the Value Balancing Alliance. And it is a real pleasure to convene such a distinguished group of speakers and participants today for what is a highly timely and important discussion. Today's session, Establishing Resilience Indicators for Transition Finance, really goes to the heart of a key challenge we are all collectively facing: how to move beyond high-level sustainability narratives and translate transition risks and opportunities into decision-useful, financially relevant signals. So we know that hard-to-abate sectors, whether steel, cement, aviation, or shipping, that these sit at the center of the transition challenge. They are all capital intensive, exposed to policy uncertainty, and operate within tight margin structures. Yet they are also essential to the global economy. So this makes the question not whether they transition, but how credibly, how quickly, and at what cost. So at the VBA, our work together with Deloitte focuses on developing resilience indicators that help bridge exactly this gap, translating transition and physical risks into cash flow relevant metrics, supporting valuation, capital allocation, and risk management decisions, and ultimately enabling financial markets to better price resilience and transition pathways. Today's agenda reflects this journey from theory to application. Just very briefly, now an overview. We will begin with welcome remarks from Christian Heller, CEO at the VBA, and Wiebke Merbert, a partner at Deloitte, who will set the strategic context for the discussions. We will then move swiftly into expert insights, first on resilience and the resilience indicator model by Deloitte. And then we look at the broader perspective of capital markets and infrastructure opportunities with the World Federation of Exchanges. These two expert discussions will also lead us into the panel where we will explore further how we move concepts from theory into practice. And that means how can these concepts be ultimately operationalized across policy, markets, data, and real-world use cases, with perspectives from E3G, again, the World Benchmarking Alliance, Deloitte, and the Future of Sustainability and Sustainable Data Alliance. We will close with a public Q&A today, so I encourage you all to actively engage and share your questions throughout the sessions. You can do that by pressing the chat function. And with these brief introductory remarks, let me really hand over now to Christian Heller and Wiebke Merbert for the opening and welcome remarks. Thank you for joining us.
So welcome everybody. First thank you goes to Martina, the team, and our network contributing to the work which have been done, which we're going to introduce today. So many thanks to all of you contributing your time, your efforts, your brains into that work. As Martina said, we're talking about transition finance. We're talking about also the right and better data in the end to inform capital markets where to invest. This goes back to a history which we are trying to bring together in the Value Balancing Alliance. History means first approaches have been published by the luxury good company Caring back in 2019, talking about environmental profit and loss account. At the same time, a few other companies have started to work on, call it integrated profit and loss accounts or impact statements, to think through how can we provide more meaning into ESG data when we're talking about risks and opportunities, when we're talking about sustainability challenges, and how do we translate data points into meaningful information. And meaningful information not just for the sustainability experts, meaningful information for the key players within the business community. That means within the corporates, finance, accounting, controlling. That means in the financial markets, all the people who are really providing capital for the transition we are all in. So a remarkable year was 2025, where a new player, the Capitals Coalition, has set up the so-called Impact Value Standards Board, which is further standardizing the methodologies around what we call impact accounting, so that we get comparable data into the market by corporates. We as the VBA are fully supporting this movement to standardize these methodologies, and we are here in the end to collect, coordinate, and bring in the business perspective. And when I say business, I mean the corporate preparers, I mean the financial market actors and the assurance professions in this regard. What we are heading for is bring information to the market so that outperformance with regard to sustainable value creation and business resilience is going to be financially rewarded. And therefore, the work, what we are doing here with regard to a resilience indicator is by far more than timely, because in the end, it provides additional information and assessment tools how, in the end, you can look and value an enterprise. Saying this again, many, many thanks to the complete team. First of all, for the content you have provided and developed, and second, setting up this meeting to share our knowledge and our ideas with a broader audience. Thanks all. Handing over to Wiebke.
It had been so many thank yous already. Thank you, Christian, for handing over. Thank you, Martina, for organizing that. So the next couple of phrases will be more focusing on the narrative. Why do I say so? The Next Gen EU is headed for a stronger, more resilient Europe. You know that. And we were thinking and coming from the angle, how do we get the corporates more resilient? By transparent data, focused data, and how do we get the portfolio more resilient? So having that narrative be spoken, I want you to count in the next 1 hour the words focus and the word resilience, just to make sure that this is really about the resilience indicator. And let me give you some more details why I stress that focus. It's the new ESG abbreviation comes along with energy, security, and geopolitical information, and all those are concluded in resilience. And if you focus on ESG, then there's the resilience. If you focus on sectors, Martina already stated this, it's hard to abate, to concentrate on furthermore. And if you focus from a business angle, you want to ask yourself which business model is resilient in the future and how do we quantify that? So the last one is how do we look at this as an investor? We focus on KPIs and we focus on quantitative KPIs rather than storytelling. So putting all that together, I wish you a very, very informative panel, and I thank my dearest colleagues, Jens and Alexander, for the support and for the writing and for the thinking and for all the quantitative work you put in there. And handing over to Martina.
Thank you very much, Christian and Wiebke. And really, without further ado, I'm delighted to introduce our collaboration partners and calculators, Dr. Jens Lausen and Dr. Alexander Schleifer here at Deloitte. And they will now present the resilience indicator model for hard to abate sectors that we have programmed, co-developed and written about over the last few months. Over to you. Thank you.
Thank you so much, Martina, for handing over. And thanks, Christian and Wiebke, for setting the scene and providing the narrative on the importance of resilience. First of all, before I want to deep dive into the paper, I think I want to thank the co-authors of the paper, Martina, Michael, and Alex. I think that was a really nice collaborative work between Deloitte and the VBA, and a lot of fun to develop this paper. And I'm happy to be able to present it today together with Alex and to give, let's say, a joint overview of our results or a brief overview of our joint results, and happy for further discussions. Yeah, so let's deep dive. As already stressed within the paper, we propose more or less a claims framework with our considerations and first empirical iterations for establishing a risk-based resilience indicator for hard-to-abate industries. So we focus in the paper on HTA sectors, and in particular, as you can see on the slide, on cement and metals and mining. And as Wiebke already stressed, those sectors face nonlinear transition constraints, for instance, due to long CapEx cycles, and also, as we all know, rising physical hazards like acute floods or chronic stresses like water scarcity. And these factors, especially for HTA companies, transform into substantial risk for the firm's performance and therefore directly affect operational continuity and therefore revenues and costs, and thus have an impact on asset value and financing conditions. So what we do in terms of the RI is we define a firm to be resilient if it can sustain value creation under transition and physical risk pathways, which means more or less how well are firms prepared and can react or adapt to stressful situations due to these risk channels. To measure resilience, we follow the climate financial disclosure frameworks and differentiate transitional resilience and physical resilience, and capture the respective risk channels. And you can see some specific examples here on the illustrated on the slide. Most of them are the usual suspects. I don't want to go into details with that. I think the paper is quite extensive on what we included in our model. What we evaluate are more or less the firm's resilience, and we consider the exposure and sensitivity to these risks channels, and then assess the firm's adaptive capacity relative to their industry peers. And what we do, as for most indicators, at least it's our aim, is to be audit ready and decision useful for investment decisions. So in that respect, please move to the next slide. We also want to explicitly delineate the RI from ESG scores, as it has a more or less different objective. I know there's a lot of different ESG scores out there, and I don't want to say that ESG scores are worse or bad or better. It's just a different objective, as ESG scores more or less aggregate heterogeneous topics to indicate ESG performance. The RI, however, provides a more interpretable finance-grade resilience signal and is based on a selected set of indicators with clear directional meaning, including causal risk drivers and considering a firm's exposure, sensitivity, and adaptive capacity, as already mentioned on the first slide. And we base the RI on a transparent weighting to support indicator level explanation. That means we provide an interpretable signal with an option to further drill down into the different dimensions and sub-indicators with indicator level explanation. And I think I will now hand over to Alex, who will give you a better picture on the methodology and the logic of the model.
Thank you. So let's move to the next slide, please. Thank you. So building on what Jens showed on the previous slides, our first version of the RI is structured around transition resilience and physical resilience, but also supported by a company's governance and strategy. So rather than trying to capture everything, as Jens just mentioned, below a broad ESG data umbrella, we deliberately focus on the components that are most relevant for resilience in hard-to-abate sectors. Methodologically, we used a stage scoring approach, and that's what you're seeing here on the right-hand side in that data structure box. And if I start from the bottom, we took data points, standardized them into 0 to 100 scores to have them in a more comparable fashion, and then grouped them into thematic categories. All those data points received weights adjusted to the sector we were analyzing, which Jens has already mentioned, and also those categories received specific weights resulting from the probability of risk materialization, and cash flow relevance. And finally, on the top, we have the aggregated resilience indicator value. So that is on the methodology. If we have the next question would be, of course, okay, I have the indicator, but what actually represents it conceptually? And that's what we have on the next slide. And this also shows how it becomes useful for portfolio decisions. So if we can jump to the next slide, please. Perfect, thank you. Because this slide is really the conceptual heart of the framework, as it shows in a very simple way what we have just aggregated through the stage approach. We start on the figure there, we start from the left-hand side. We have those two risk domains we mentioned before, transition risk and physical risk. And on the transition side, we have things like policy shocks and those Jens already showed on the first slide, where we had adjusted them to the particular sector we were looking into, and the same applies for the physical risk side, like water stress and hazards, an example. And the next step is to assess how companies in the sectors are positioned against those risks. So we asked the three core questions shown here. What risks do firms face operating in that sector? How affected are they likely to be? And how do they respond to those risks? That is the governance and strategy part. That is the logic behind exposure, sensitivity, and adaptive capacity. And it's also where the weighting logic I just mentioned comes into. So we do not only look on whether a risk exists, but what happens if it materializes, and we look on it from a cash flow perspective, and whether the company is taking credible steps to manage or to mitigate those risks. And this then feeds into the three sub-pillars of the indicator: transition risks, physical resilience, and governance and strategy. So conceptually, yes, we have an overall RI score in the end, but we're not trying to collapse everything into a black box number. What we are trying to preserve is the logic from risk over cash flow relevance to resilience. And that is precisely why the framework becomes useful for portfolio decision making. However, and that's what Wiebke also mentioned in the opening, it also serves as a benchmarking tool for companies operating in such a sector themselves, helping them to compare their resilience profile against peers. More important, identify gaps and define more targeted resilience ambition over time. And with that being said, I would like to conclude our presentation and look forward to the next one, as well as to our discussion later. Thank you.
Thank you very much, Alexander and Jens. We are moving swiftly over to the next expert insight by Rona Nern from the World Federation of Exchanges. And again, encourage everyone to post their questions in the chat. We will come back to everyone right with a panel debate after these expert insight sessions. Thank you.
Perfect. Thank you, Martina. Like Martina said, I'm Rona. I'm from the World Federation of Exchanges, which is a trade association for stock exchanges and CCPs, central clearing party. This webinar is about resilience indicators and the links to transition finance. And what I'm going to talk about here is how you use all that great resilience data to actually improve your access to transition finance. And I'm going to be outlining the contents of a guide that we published at the end of February. It's called Accessing Transition Finance, a Practical Guide for Issuers. And it's going to be part of a series. It's the first in what is going to be a series of practical guides for listed companies, which are each going to be focused on a different theme. But the first one is focused on transition finance. So moving on to the first slide, the guide is written for companies across all sectors, and that includes hard to abate sectors, and it provides practical direction on what transition finance actually is and why it matters. the transition finance market now and how it's developing, how to best position your business to take advantage of emerging and evolving opportunities in this space, and what is next for transition finance, a bit of a look ahead to what's next. So thank you. Thanks. So the first section looks at what transition finance actually is. The most important thing to note is obviously that it doesn't require organizations or their activities to qualify as green or sustainable now, but rather the essence of transition finance is improvements in climate and sustainability performance over time. And this is what makes transition finance so important for hard to abate sectors, because these sectors are otherwise excluded from green and sustainable financing opportunities. However, all that said, there is no universally agreed definition of what we mean by transition finance. In our guide, we walk readers through some of the most prominent conceptualizations, if you like, and that includes those used by the OECD, the World Economic Forum, and several national regulators. But what we found was that common amongst the different conceptualizations are requirements to demonstrate credible transition pathways towards net zero, and also to evidence progress along those pathways over time. And so we treat transition finance as it says in the slide, financing that enables the credible science-linked transitioning of business models, activities, assets, and value chains towards net zero and other sustainability-related goals. But this definitional piece is really a missing piece, if you like, to the puzzle. And convergence around this is going to be critical in establishing and growing the market further. The next section looks at why transition finance is important. Why is it important that we're getting these resilience indicators and using them as effectively as we can? Well, global finance exceeded $2 trillion in 2024, but that still falls far short of net zero needs. So there's a lot on the table here. And on top of that, as we've already heard today, physical and transition risks are starting to materialize and escalate, and that is increasing appetite amongst investors for resilient businesses and investments. So in the guide, we outline the business case, if you like, for making the most of transition finance opportunities. And that includes that featuring on dedicated platforms, databases, indices, and benchmarks improves businesses' discoverability and liquidity. Organizations are also able to benefit from a greenium, as it's called, which is essentially a green premium from investors that are willing to pay more or accept lower yields in exchange for sustainable impacts. Businesses can also benefit from lower cost of capital via instruments that link the cost of capital with their sustainability performance or expenditure. And then beyond financing, having a strategy in place that actively manages physical risks as well as transition risks like rapid regulatory change supports resilience and long-term value for companies by reducing the probability of assets becoming stranded or physically damaged, of reactive compliance costs, of reputational shocks, and also just losing out in the face of changing market demand and consumer preferences. And then lastly, businesses that begin work now to transition, this is why it's important to act now, and capitalize on those early financing opportunities, are going to benefit from enhancing the strategic value of their transition planning, and they're going to gain a head start on formal regulation as well. So then we move on to have a look at the market now and how it's growing. So what are those opportunities that we're talking about? Well, achieving the frankly unprecedented levels of investment that are needed to decarbonize whole economies is going to depend very heavily on private capital channeled through financial markets. And that is where public markets are really stepping up to meet the challenge by providing vital market integrity, credibility, price discovery, liquidity, and transparency. And with all the work that is going on in that sphere, it's really important that businesses stay on top of the evolving landscape and the opportunities that are out there. So to help with that, the guide outlined some of the most significant current and emerging vehicles for transition finance that businesses should be aware of. It looks at use of proceeds instruments that provide businesses with access to financing based on the expenditure that they dedicate to green and sustainable purposes. It also takes a look at sustainability linked instruments that tie financing to sustainability performance. And for those financings not necessarily ring fenced for specific projects or purposes. So that's an opportunity for finance to be allocated in line with broader strategic priorities, so long as relevant targets are met. The guide also walks readers through blended finance structures that combine public and private capital to attract and amplify private investments. These structures are particularly suitable for projects with high upfront costs. So hard to abate sectors in particular have a lot of those, and markets where investors may perceive heightened risks too. We also examine the role of secondary markets here because secondary markets provide liquidity, they facilitate the trading of transition-related securities, they act as a risk management mechanism for investors, and they also establish credible pricing for transition-related assets. And then lastly, in addition to the opportunities for direct financing that I've just talked about, businesses are also able to benefit from enabling initiatives too. And by that, I mean things like green and transition-focused exchange segments, which publicly designate green and transition equities. Several of our members already have designations like this or are working on designations like this, and that's a trend that we're expecting to see grow in the future. So for all of the above, the guide provides information on how demand is evolving and the key considerations that businesses should be bearing in mind when they think about which vehicle or vehicles are right for their business. Then we look at how businesses can position themselves to actually maximize their access to transition finance. So the guide outlines the actions that businesses can take now to capitalize on the opportunities. And those include developing credible transition plans that drive value, that enable access to the right financing opportunities for your business, and that prepare for evolving regulatory requirements, stakeholder expectations, and also risks. The guide also recommends that businesses future-proof their approach using key global standards and initiatives, and it points readers to those key standards and initiatives as well. It provides direction on how to choose the right instrument, which is a really, really important step. And it includes some illustrative examples of how different companies, including companies in hard to abate sectors, might go about selecting the right instrument to help businesses think about how this actually all applies in the real world. And then lastly, the guide encourages businesses to think very carefully about their evidence and their assurance, including how digital reporting and assurance can support investor confidence and influence capital allocation decisions. And finally, the guide looks at what's next for transition finance. So as mentioned earlier on in the presentation, an internationally agreed definition could really propel growth here. And so as a result, businesses should expect transition-related standards, taxonomies, and guidance to continue to evolve and to become more and more embedded in regulation. And in fact, that's something we're already seeing through the ISSB standards, which is a standard setting initiative run by the IFRS Foundation, which is now quite widespread in regulation around the world. Investor demand for comparable decision useful information on transition plans and progress is going to continue to grow. However, companies should also expect regulatory uncertainty and fragmentation to persist as well, with some jurisdictions re-evaluating their sustainability commitments whilst others are forging ahead. And that's going to make it even more difficult to plan strategic approaches to transition finance and resilience here. In the meantime, though, communities of good practice and peer learning are really stepping in here to advance global progress and also support future harmonization. We've had the Task Force on Climate-related Financial Disclosures, one on nature-related disclosures, and recently the Task Force on Inequality and Social-related Financial Disclosures was established. These are all private sector-led initiatives. And then we're also seeing work like the VBA's fantastic work on resilience indicators, which is enabling more nuanced approaches to areas like scenario analysis, transition pathways, transition variants, and also risk extensions. And then finally, just last point to note is that transition finance is actually broadening its focus now beyond carbon emissions to also consider nature and social dependencies and impacts. And actually, the ISSB is already advancing work on this in relation to nature-related disclosures. So that's something to look out for too. So just to summarize, I suppose looking at these in the round, all of these developments point to a more structured and multi-dimensional transition finance landscape where businesses that invest early are going to stand to benefit the most.
Fantastic. Thank you very much for that overview and setting the scene and context for the business case and the investor case for transition finance. I know we will dive much more and much deeper now into the subject by bringing other experts into the group. So I'm delighted to open the panel discussion, which will include our current expert speakers, Dr. Jens Lausen and Dr. Alexander Schleifer, Rona Nern, as well as Pietro Cesaro from E3G, Nikki William Bihari from the World Benchmarking Alliance, and Will Goodhart from the Future of Sustainable Data Alliance. Delighted to having you all here. And I'd like to open the session, which hopefully provides a bit of a deeper dive as well again into some of the fundamentals we have highlighted for transition finance and for defining resilience, preparedness and adaptive capacity alongside physical and transition risk management, planning and finance. And with that, maybe I bring quickly Jens back into the picture. Jens, could you restate very briefly how the VBA and Deloitte Resilience Indicator model, how it aims to move beyond broad ESG narratives, and which criteria do you see as the most decision useful for high to abate sectors, and why?
Thanks very much, Martina. I will, of course, answer the question in the context of our resilience indicator, and also already presented and stressed today. DRI is more or less delineated from ESG scores and has a more climate-specific risk driver focus. So we don't want to have all of the ESG aspects included, but more like an E aspect. And as already said, DRI is structured around transition resilience and physical resilience. So regarding the most decision useful criteria, I would also like to split my answer because both dimensions need to be adequately addressed. So it's more like a personal view because I don't want to go too much into detail because there's a lot of criteria, I think, which is very interesting. But for transition, I would say one of the most relevant criteria is the most obvious, of course, carbon costs. Policy-driven carbon costs can be easily modeled into margins and cash flow considerations. And I think we all have done something like that. So I think regarding resilience, this is one of the first ideas that I would include and that we also, of course, included in our considerations with DRI. What I think is further interesting and more of a challenge would be something like CapEx lock-in. I think if a firm is once committed on a specific asset, there's not a lot of flexibility for years, and it's harder to model how firms address these issues. And I think if we could get better data on that, that would also be more decision useful. And I think there's a lot to come and more interesting discussions how to model this ideas. Regarding physical resilience, also the most obvious are acute hazards, which are, of course, material for the operational continuity. And if you have a good picture of how sensitive the operational parts of a company are to acute impacts and how long a firm takes to recover, this is, of course, extremely valuable information for assessing the assets of the company. And of course, in the last years, what we've seen is a lot of improvements in physical risk models. And I've seen a lot of those physical risk models, and it's getting more interesting with geodata and geospatial data to get better insights in how to, for instance, check whether certain production sites have increased hazards and what is the how companies can cope with that. And maybe last one from my perspective, which is maybe not for now pretty important, but I think it's quite interesting to check whether firms have a good idea of how to address future chronic stress situations, so such as water stress. A lot of companies, especially in hard to abate sectors, have high dependencies on water, and it would be very decision useful to know how they address these issues. And I think to get a better idea, better data, and also the ideas of the resilience indicator would help to make better investment decisions. So I think that's my ideas, but there's of course a lot different more dimensions that we included in the resilience indicator, and I think that's four aspects that I think are quite important, relevant, and also interesting to look into in the future.
I'm delighted to work on that, of course, in more detail. And as you highlighted, carbon risk, water stress, ultimately land use and risk. These are key indicators that have an impact on the sectors that we assess: cement, metals, and mining. But bringing in also Alex, into the discussion, when we look at then translating resilience into the different variables that matter for financial markets at an aggregated level, so to say, what are these sort of key resilience indicators that matter, for instance, for cash flow durability, for capex needs, margin pressures, financing costs, so also for downside risk protection, Alex?
Yeah, it's exactly, and that's what our resilience indicator wants to show. Like, the key point is that the model starts from risk transmission channels. It looks at transition and physical risks, breaks them down into exposure, sensitivity, and adaptive capacity, and then asks how those channels may affect the variables financial markets actually care about. So if a company is highly exposed to policy shocks, technology constraints, or physical hazards, and has limited adaptive capacity, that can translate into higher capex needs, margin pressure, operational disruption, or downside risk. If, by contrast, a company shows stronger preparedness, a credible strategy, robust governance, that points to greater cash flow durability in the end, and potentially lower financing frictions over the time. So the key points are looking on specific data for the company, or the company's sector it is operating in. And what Jens already said, if we have more geospatial data, we can look more into those plant sites, etc. And this is exactly what financial markets care about, to have a better idea of the risks it's facing, specifically on the cash flow and business side.
Thank you very much. And I'd like to bring Rona back into the discussion, because, of course, market infrastructures are really at that convergence point, between issuers and the real economy, and, of course, financial markets and capital allocation decisions. So maybe, Rona, from what you also presented, and you highlighted the role and the key focus area of resilience as well during your presentation, where do you see the VBA's resilience indicators actually amplifying and interacting with the work that's already been done by exchanges, maybe issuers, and or other capital markets participants? It'd be great to get that perspective too.
Yeah, thanks, Martina. I mean, what's so great about the resilience indicator model is that it brings together and it provides a kind of bridge for the two concepts of impact and financial materiality. And that's really helpful for transition finance, because, as we know, your traditional delineations between financial and impact materiality don't really hold in a context where physical and transition risks are increasingly coming down to bear. And considerations that may historically have been considered to be material just from a kind of an impact point of view are now being brought into that financial materiality sphere. And that is why we are seeing broader evolutions in how materiality is actually conceived anyway and assessed, with concepts like enterprise value and dynamic materiality starting to gain favour. And as those conceptualizations kind of gain prominence, it's really important that the transmission channels and pathways for climate risk to become material to businesses' value are clear for companies and investors. particularly for hard to abate sectors, because they are going to be impacted the most by this. And that's where these resilience indicators come into play, because they provide clear, transparent, and forward-looking assessments of whether a business is actually able to maintain value creation and protection, and whether their current revenue streams are going to remain tenable under plausible transition and stress scenarios. And that links really well with all the work that exchanges and their issuers are doing to produce and promote decision useful information on companies' sustainability risks, opportunities, and transition plans, which, Jens was talking about the data that's needed. Well, we are working on providing that data as far as we can. But resilience indicators are going to enhance the decision usefulness of that data and that information, and enable strategic investment decisions that prioritize long-term value. And they're also going to equip businesses to make more accurate assessments of the risks that they're facing in different transition scenarios, so that they can proactively manage those risks and protect their revenue streams.
Thank you very much, Rona. I know we're going to hear much more on this, as we all will be also attending and speaking at the upcoming World Federation of Exchanges event in June as part of the Luxembourg Climate Finance Days, I think the first of its kind. So very keen to hear as well about the role that exchanges can play right alongside these issuers, as well as the capital market participants. But bringing also into that debate now, Pietro Cesaro from E3G, you have done also great work on looking and assessing the policy landscape, which is a key enabler for transition finance. So maybe, Pietro, if you could set the scene a bit about our, obviously E3G's work here, and highlight how the policy landscape for transition finance is evolving, and what should ultimately financial institutions watch out for and watch most closely when assessing the credibility of transition pathways in high to abate sectors.
Thanks a lot. Thanks a lot for the invitation. I will answer mostly on with a European lens with regard to the sustainable finance policy landscape, because that's my area of expertise. In Europe, the transition and sustainable finance policy landscape has been facing a sort of reassessment, and at the same time of the reassessment in restructuring some relevant directives like the Corporate Sustainability Reporting Directive and the due diligence one. It has faced a moment of implementation. So now first data are arriving from companies, and in this peculiar policy moment, I think that the most important thing from a policymaker is giving a cycle of regulatory stability for the next period. So implementing and embedding what is already there, it's very much important. At the same time, internationally, but mostly in Europe, we have faced, as I was mentioning, this reassessment impacted by this simplification wave, which is very much appreciated when it's evidence-based and not politically charged, let's say, because there are some elements that could be integrated into the sustainable finance landscape, like these resilience indicators. So if we go through a deregulation only wave, this interesting work risks not to be embedded, and I think it would be a pity. At the same time, we are observing at European level an increase in overall data availability, and maybe I can further develop after. But this amount of corporate data, I think it's very much relevant also, not only for financial institutions and for other actors, but also for policymakers. I think there is a sort of barrier between transition plans, entity-based information, between these and policymakers' offices. And this is because of an absence of a sort of feedback loop between this kind of information flow. And very happy to further bring E3G work on this later, but it's the point is let's find ways to use this data and bring them not only to financial sector and investors, but also to policymakers so that they improve their policy making. Very quickly on credibility, I think the principle of follow the money it's relevant. So check the capex and opex financial planning and then compare it to the decarbonization strategy of the company is relevant to see whether it's credible or not. Check the geographical dependencies and legal dependencies of the company, which is of course very much geographical based, and see whether these dependencies are in line with the potential bottlenecks that corporations are facing, and ensure that emissions reduction targets are backed by important scenario analysis. It's quite relevant, and I must say that I'm a big fan of this work that you're doing. So to understand the resilience and the capacity of the business continuity of a company is quite relevant, this work on resilience indicators. And so I must say that I'm sure that this will inform a lot the credibility discussions on transition plans in the next period. I stop it here.
Thank you very much, Pietro, and thank you also for that feedback. Maybe a quick additional question. We talk a lot about, transition finance frameworks and pathways, and hence, as you highlighted, we are trying to move the debate a bit away, not away from risk, but also towards resilience. And maybe you see as well certain aspects where current transition finance frameworks really fall short in supporting real economy transformation, particularly for the sectors that we've been assessing here, with long asset lives and uncertain technology pathways. Could you provide a couple of comments and insights here? And then I, of course, bring also Nikki into the debate that has some more insights from her report in regards to the assessment of the World Benchmarking Alliance. But please, Pietro, first over to you.
Yeah, so with regard to the investment framework, I was mentioning that I would have elaborated a little bit more. And so you're also mentioning at sectorial level. What we are doing at E3G is, as I was mentioning, try to go beyond this barrier between information at transition plan level, at entity level, and policymakers. So the connection is what is the transition plan of policymaker? It's, for example, in the EU is the National Energy Climate Plan, or like they are producing many plans at national level, also the building renovation ones, but the one that it's let's say centralized as much information as possible, it's in our assessment the National Energy Climate Plan. So what we think, and also in line with the political discussion in the EU, is that these plans at national level, they should become more investable. And by investable, we think provide information and signal that are more in line with what investors and private sector are requiring from policymakers. We have developed this sort of 4 principles where we believe that by following these principles, national plans could become more investable and provide more information. So the first is having a whole of economy approach. So even if you don't have all the sectors, you have an approach that is considering all the economy. And here I answer to your question on some of the hard-to-abate sectors. We need a sectorial approach in national transition plans, and so sectorial pathways and sectorial plans. Then also in line with your resilience work, we believe, because this work was informed by surveys that we have done with the private sector, we believe that resilience and risk must be embedded in this work, and at least at national level, adaptation plans or climate risk assessments must be made in order to inform investors of the awareness of policymakers of what and where is the risk, so that capital allocation can be supported. And this is the second principle on risk and resilience. The third is more credibility, and by giving more credibility, we think integrating not only the environmental and climate ministries in producing these plans. There is the need of including also finance ministries for doing a relevant and credible budgeting exercise so that the actions are more credible. And the last one, integration of information from the private sector. I will stop I will stop in 30 seconds, but I wanted to mention that we are doing a project on identifying how transition plans can be aggregated at sectorial level in order to produce information that can inform national policymakers. Because, as I was saying at the beginning, of course, national plans need to be more investable, but there is the need of this feedback loop with bottom-up information as well from the private sector. I stop it here, but the investment framework need to be more aware of this connection between public and private, and not only on projects, but also in how to structure the transition at national and entity level.
Thank you so much, Pietro. And I'm sure you and the other speakers afterward will share also references to your work in the chat so that others can follow up from here. And of course, get engaged. That's the idea as well. Bringing in Nikki William-Bihari from the World Benchmarking Alliance, who've recently assessed in much depth 2,000 plus companies in regards also to their transition plans and efforts. I'd love to hear more about your key findings. If you could quickly summarize these as well and give us an idea how so far actually companies, especially in hard to abate sectors, are tackling transition plans.
Yeah, and so much to build on from what's already been said. I think we can follow up and connect with the other speakers. Thank you, Martina. Yeah, so you've mentioned there, so at the World Benchmarking Alliance, we are assessing 2,000 of what we call the world's most influential companies. So really focusing on those big companies that can have that systemic change. And it's all open source information, so I'll drop a few links in, but feel free to have a look at all of this. Everything that I mention is there and publicly available. We're doing that across a range of key sustainability topics, but one of them being, as you said, their climate transition plan. The methodology that we're using is one that was developed with or by ADEME, so part of the French government, so over 10 years. Well-established methodology, and I think that's important when you mentioned credibility. I think was one of the questions earlier, and obviously we can always be evolving and building on methodologies, which is fantastic, but it's important to have that kind of science-based and credible methodology underneath and underpinning. It is looking at a sectoral approach, so it's not so focused on the difference between geographies, but more from each sector. And that is bringing me, it's very live. So we did publish our assessment on 1,600 of the real economy companies on their climate transition in January. And right now we've got some of my team who are at the Transitioning Away from Fossil Fuel conference, which is taking place at the moment in Colombia. So we kind of aggregated some of these results. I was pleased earlier, I don't know who it was, but someone mentioned about CapEx, for instance. So I actually brought some stats around CapEx, which is wasn't lined up, but I think fits in well here, particularly in that hard to abate sectors. So just to dig in a little bit there, for instance, in a sector that we are seeing quite a lot of development in terms of transition planning, and including companies that are showing that CapEx into low carbon investments is possible. That's in the electric utilities sector. So in that sector, we have 31 companies that we've assessed. And again, these are the largest, most influential electric utility companies in the world. Their average low carbon, or their average CapEx, I should say, is 51% is dedicated to low carbon investments now. And even three of those companies, three really large companies, out of their full CapEx investment, we're talking about 93% of that now being in low carbon investments. And there's a whole technical methodology behind that. I won't go into any of that because I know we're short on time, but there are other sectors, hard to abate sectors, that are not so far along. So I've just given the ones that are, but there are sectors for instance, in the steel companies that we assess, the average there is 15% of capex investment into low carbon. The kind of need to be on a 1.5 degree trajectory would actually be around 80% of their capex. So these kind of stats and figures are the things I think which help build into and build on and leverage connect to some of the indicators that we've heard today. Maybe I'll just finally say, because obviously we're touching here more on resilience, and very much a takeaway for me is to look further into the methodologies which has been shared. We've, as I say, just assessed companies around these topics, but actually right now we're live in consultation of how we should evolve our assessment of these 2,000 companies into a more integrated transition approach. So really connecting the social, nature and climate transition plans together. And so I think I'll just, conscious of time, Martina, I'll just mention that I think what's key is for us, for instance, in this consultation, to look at the work that you've done and look at how we can bring some of that insight and leverage some of that in that new assessment phase. So I'll pause there because I know we're short on time. Thank you. Hand back to you, Martina.
Thank you so much, Nikki. And absolutely, I've also seen the email today from the WBA on ultimately the consultation. So probably encourage everyone, right, to get involved. And absolutely, we will get engaged and would be delighted, I'm sure, with our close collaboration partners from Deloitte to also share more on resilience. Done something recently as well with the World Federation of Exchanges and their work, much more on this to come in due course. Maybe last but clearly not least, you highlighted, Nikki, the question around credibility. And again, Jens and Alex highlighted earlier our challenges with actually modeling, also in regards to the current constraints and maybe the lack of availability of, sufficient data, at least data that is also available beyond paywalls for research purposes, but maybe bringing Will here into the discussion and getting his perspective on what we see in regards to company reported data when it comes to transition finance, and where is this data modeled, estimated, and ultimately where do we see proxies versus real reported information, and is there a challenge with the data, or is that not the case? Is that exaggerated? Will, what can we do to enhance the credibility and the data availability questions that we have seen arising as well today?
That's a really big question, and I will come to address it. But first of all, I just wanted to compliment you and the team on a really interesting piece of work. I think this idea of focusing very specifically on the adaptive capacity of companies, as described sort of by cash flow to address sectoral specific transition risk, I think that's quite interesting. There is quite a lot of other analysis and data available in relation to things like physical risk and governance. But I think that you've hit on an area where there perhaps is a need for more insight. As you say, I think that we're in a situation where there could have been more data becoming available through time because of reporting requirements under CSRD or CSDDD. That's no longer perhaps going to be the case. We will have more limited statutory reporting requirements, regulatory reporting requirements, and so there will be more, I think, need for modeled and estimated data. I think the good news is that that should be available. I think that there's enough other data that is being reported, perhaps under S2 rather than in a separate transition plan, to allow that kind of inference to take place. And additionally, with the increased computing power that we're seeing, the implementation of AI models, I think that there should be more ability to bring more insight and more information to end users in time. I mean, it would be more we'd probably have a preference to have more reported data available because it's assured and perhaps more reliable. But in the absence of that, I think the ability to infer information is increasing, and the available data to work with on that inference is also increasing.
Thank you very much for the comments, also for the feedback, Will. And I know we are running a bit short now of time for today, but Foster is doing fantastic work when it comes to data on the policy and regulatory side, on assessing the specifics and thematics around different data sets that you also highlighted, like, for instance, ISSB, S2 information, of course, for climate relevant disclosures. That came also up earlier in the discussions from, I think, Pietro and Nikki. But let me maybe then conclude today, and first of all thank everybody. I can't see any further comments, questions in the chat for now, but also to encourage everyone online and everyone here that has participated to remain engaged also with the speakers. We continue, please, to put our key reference materials and links into the chat. We will also share afterwards with all registered participants from today, which there were more than 80. We will share ultimately today's links and materials as a follow-up notification. And ultimately, that really brings me to the closing remarks. And a couple of key reflections from today. First of all, that resilience is not just an abstract concept. The way we foresaw it was to be a translation mechanism for decision useful indicators alongside mainstream financial market decision-making tools that can also directly link hence to financial performance indicators. We heard from Alex and Jens the links to cash flow durability, capex requirements, cost of capital, and downside risk protection. And second, we've heard it from multiple speakers today, the importance of credible, consistent, and interoperable data. And that sort of dependency as well towards credibility and data cannot be overstated. But thanks to Will, we've heard there's a lot of work in the works, especially on physical risk data and information, but also on aligning on the transition risk side, and hopefully in future with all of our work and expanding the methodologies, thanks to Nikki for this, in and around resilience, adaptive capacity, and preparedness. And third, and most importantly, we see a clear role for financial markets here, not just as observers, but ultimately as active enablers of the transition, through the pricing mechanisms, the stewardship and engagement opportunities, and through innovative finding structures that can support real economy transformations, outcomes and impacts. Again, we will highlight much more on this as the VBA continues to bridge the work between externalities, impact valuation, and financial decision making. And we work collaboratively with all of you as partners, but also in the wider ecosystem to really move from methodology and concept to markets and applications. And hence, maybe let me just say that today's discussion is a very much important milestone in our own development from concepts, business-driven research towards ultimately applications and toolkits. There is much more to come. You can see briefly here our key ambitions and pillars for our work, and we'd like to stay connected. We have many more discussions coming up across all, so to say, financial markets segments, and we will be very actively involved in the upcoming London Climate Week, Luxembourg Climate Finance Days, China Climate and Impact Weeks, and hence encourage you as well to have us in mind for further discussions, speaking opportunities, and of course projects. So a very big thank you to all of you today that have already live listened in. There is much more to come, much more to work on, and I'm very much looking forward to all of your feedback. Thank you to the speakers today. Thank you to the participants, to our hosts and partners. Thank you very much, and see you very soon.